Welcome to Immediate Insight News. For years, the brands that fill our medicine cabinets and linen closets, Huggies, Tylenol, Kleenex, Band-Aid, have been rivals in the massive consumer goods sector. But today, the game is over. In a stunning corporate power play, Kimberly-Clark, the company behind Kleenex and Huggies, has announced the acquisition of Kenvue, the maker of Tylenol, Listerine, and Neutrogena, in a monumental cash and stock deal valued at approximately $48.7 billion. This is not just a merger. It is the birth of a consumer health goods behemoth expected to generate a combined $32 billion in annual revenue. The news immediately sent Kenvue's stock soaring by over 20%, while Kimberly-Clark's stock dropped by more than 15% pre-market, reflecting investor concern over the sheer size and cost of the acquisition. The central question defining this historic corporate consolidation is this $48.7 billion deal a brilliant strategic move to achieve unassailable market dominance, or is Kimberly-Clark paying a desperate premium that threatens to destabilize its core business in a fierce, costly gamble for consumer health supremacy? Over the next few minutes, we will break down the terms of the deal, analyze the shocking market reaction, and reveal the enormous cost savings that Kimberly-Clark is banking on to justify this massive corporate risk. The merger between Kimberly-Clark, KMB, and Kenvue, KVUE, creates a giant that will touch nearly half the global population with brands used from birth through old age. The brand synergy. The combined company brings together two powerhouse stables of brands: Kimberly-Clark, Huggies diapers, Kleenex tissues, Cottonelle toilet paper, hygiene and essentials. Kenvue, Tylenol pain relief, Band-Aid, Listerine, Neutrogena, Johnson's baby products, health and wellness. The financial structure. The deal, expected to close in the second half of 2026, is valued at $21.01 per share for Kenvue shareholders. The immediate shock. Kenvue was only spun off from Johnson & Johnson 2 years ago in a bid to make its consumer business more nimble. Its brief independent life, marked by activist investor pressure and CEO turnover, is now over. This rapid acquisition underscores the intense pressure Kenvue faced to stabilize its stock and strategy. The immediate market response to the deal was a stark reflection of the financial risk involved, creating a dramatic split between the two stocks. Kenvue soars. Kenvue shareholders celebrated, as the $21.01 per share valuation represented a significant premium over the stock's closing price. Investors see this as a successful exit from a tumultuous post-spin-off period. Kimberly-Clark plummets. Kimberly-Clark investors were spooked. A drop of over 15% indicates significant concern that the company is overpaying for Kenvue. The nearly $50 billion price tag adds enormous debt and operational risk to Kimberly-Clark's balance sheet at a time of high interest rates and global economic uncertainty. The primary justification for this massive outlay is the promised cost savings. Kimberly-Clark believes it can achieve approximately $1.9 billion in cost synergies within the first 3 years after the merger. These savings will come from streamlining manufacturing, cutting overlapping corporate functions, and massive supply chain efficiency. For the average consumer, this consolidation means fewer independent choices on the store shelf and massive pricing power for the new entity. The deal also absorbs the ongoing legal and public relations challenges that Kenvue has faced. Tylenol, one of Kenvue's flagship products, was recently thrust into the national spotlight over unproven claims linking its active ingredient, acetaminophen, to autism. While Kenvue and medical experts maintain the product is safe, Kimberly-Clark is now buying this controversy along with the brand. The challenge for the combined company will be to integrate the two cultures, streamline the operations, and deliver the promised cost savings while simultaneously navigating the legal and public scrutiny surrounding its new health brands. The Kimberly-Clark acquisition of Kenvue is a definitive moment in the history of consumer goods. It creates a powerful global competitor that is nearly impossible to ignore. The future success of this $48.7 billion giant rests entirely on whether CEO Mike Hsu can seamlessly integrate these two behemoths and unlock the promised synergies. If he fails, the cost of overpaying could haunt the company for decades. Do you believe the $1.9 billion in promised cost savings justifies the massive $48.7 billion price tag and the high risk for Kimberly-Clark? Or is this a clear case of corporate desperation leading to overpayment? Share your investment analysis below. Subscribe to Immediate Insight News for continuous, in-depth analysis of the volatile M&A market. Thank you for watching.